Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, May 12, 2015. Inside the numbers tonight, we're going to take a look at the SPY and the Emini contract. We're going to talk a little bit about the invisible hand underneath the market these days. We're going to talk about crude oil. It's still going higher yet. We'll discuss gold. Finally got going a little bit today. Interest rates in the bond market almost got going today. We'll talk about that one. And the U.S. dollar hopefully will get going pretty soon, okay? So very fitting for today. Let's go into the S&P or the SPY chart. This is the daily chart. And what a mess this is, right? I mean, who could read this chart? To most, this looks like disorganized chaos. You know what this looks like to me? This looks like a Rembrandt. Let me show you what's going on here, because there's a lot of stuff going on, and there's a lot of stuff going on in this market, and there's a lot of money to be made in this market if you know what you're doing. So let me try and shed some light on what's going on, or at least what happened today and where we go. So yeah, this looks like a kludge. I get it. So let's just remember a couple things. 208.97, we know that number from this line's been in there forever. Pivot high, okay, breakout, failure, okay, failure, pivot high. Here we go. I mean, how many times have we have to hit the same number to realize it's important? All right, so we have the purple line, 208.97, the downsloping trend line. Remember that one, okay, and then we'll get to this kludge in a minute. All right, so let me zoom in a second, all right, because this morning we had an early sell in the market, all right, and the market had every excuse, every opportunity under the sun to go down and sell off in a good way today, sell off in earnest. We could have had a thumping today easily, right? But it didn't happen. So it's like the invisible hand under the market. Is it options expiration week? Is that the reason? Are the institutions holding up the market? Is it the president's working group? It's the conspiracy theorist. Who knows? The buy the dip crowd, whatever it is, there's a bid under the market. All right. I've been telling you this for months. It's bullish, right? The market's going to make new highs. I've been telling you for a long time. It's still happening, okay? Whether we go down another day or two, this week, next week, doesn't make any difference, okay? We're going to hop on another rally here in short order, right? In the next week or two. And we're going to get carried to new highs, and then we're going to get an opportunity to kind of reassess where we are as we get into the summer and see if we can't play some more volatility then. But for now, let's go to what happened today. All right. So remember, 208.97, purple line here. This is an hourly chart. This is the low from the 6th. Okay. This is the high from yesterday. So I want to draw a Fibonacci retracement. All right. Get out the fib tool, and I draw the retracement from the low on the 6th to yesterday's high. Okay. And we have now a point of reference, right? We have lines in the sand where we know there should be support. Now, if we come up with other reasons why there should be support in certain areas, that solidifies the case even more so, and it builds the case for the market to either find some support and bounce or find a low and go from there, right? So let's take a look a little closer to what we have, all right? Let's take a look and see. We have the market coming down this morning, yesterday's high. We came down yesterday. We finished here. Now we gap down this morning and we start lower. And you kind of got to say to yourself, all right, where's the market going to find support? There's got to be a trade in here. The market's not going to go down all day. It's not going to go down every tick. It's not going to go down every candle. All right, it's going to find a low. Where is that low going to be? Well, let's look at what we've got. All right, I told you I drew a Fibonacci retracement from low to high. So where is the market opens up, and it opens up on the 50% retracement or almost above it, or slightly above it, right? And we continue lower. Well, the next area is the 618. What else is at the 618 retracement? Just above it is our 208.97 purple line, right? Where we had support and resistance from before. Here's some resistance. Here's some support. Here's some support. Okay. Here's some resistance. I mean, this is just obvious that this is an area of importance, okay? And then you have the downsloping trend line, right? And all of a sudden, you have converging three areas. You have a 618 retracement from the recent low to the recent high. Okay, that's going to be important. You have the 208.97 that we got from previous highs and lows. Okay, we just carried it through. And you have the downsloping trend line that has proven important many, many times. All right, let's just zoom in a little bit more. All right, let's go to the 10-minute chart. And here's what we had. Okay, market comes down, first candle of the day, we bounce off the 50% retracement. All right, looks like a decent trade. Some took the trade, maybe some didn't. Okay, but market's weak and we come down again. And here we go into the 208.97, continues down. Pierce of the 618 retrace. We had the downsloping trend line that you can't see from here. And it was boom. It was just a picture perfect trade. Bounce, retrace, rocket up, float higher all day. Okay. And that was the low. And how many times, and this is the interesting thing. So you put those three areas of price support together, and then you have to say to yourself, how many times have we seen, not even just the recent past, how many times in a long, long time, if the market goes down in the morning, okay, how many times have we seen it make a low around 10:30, 11 o'clock, 11:30, something like that, 10 o'clock even, and then all of a sudden we just float for the rest of the day? I mean, it happens like 75% of the time. The market goes down 75% of the time. It makes a low early in the morning or mid-morning, and then it floats the rest of the day. And those rest of the 25% of the time, maybe you have a down day, maybe it's a bad day, whatever. But in reality, since the market really does, and statistically this is true, the market does go up about 75% of the time. If you just counted all the days, 75% of the time the market is going higher. That's not to say that 75% of the time the market's going higher in proportion to when it's down, right? Sometimes we have really big down days and we have little up days, right? And vice versa, but nevertheless. So those are numbers, they're real. So all I'm saying is that you have all these factors and then it's mid-morning and usually the market finds a low in mid-morning. You have three areas of price support. Here's the deal, folks. If you can't take a trade with those scenarios building up on you, then you can't take a trade. Okay, that was just a stone cold buy with both hands. There was no way that couldn't hold. And if it didn't hold, what do? Okay, if it doesn't hold, your stop out is 30, 40 cents in the spider. Okay, that's the risk you're willing to take on a trade like this. If the market really is going to have a beating of a day, okay, you take a 30, 40 cent loss and you lick your wounds and you move on. But that's how much room you would give it. I'm only giving it a 30, 40 cent loss. But once I'm 30, 40 cents in the money on a deal like this, okay, you're already beginning to think, let me take half the profit back to me and let me let the rest go and I'll put a stop in the money or a trailing stop, and I'll see what happens the rest of the day, okay? Or you put a trailing stop on the entire position and see what happens the rest of the day, or you sell it all when you're up something you're comfortable with and you move on to the next trade. There's all kinds of scenarios where you can make profit in days like today. So I thought that was important. I thought it was useful information. Hopefully it is. So let's move on and let's just talk about what I think is going to happen from here forward. I think we had a good close today, okay? I think we had a decent close. I'm just going to flip over to the Emini for the sake of it. I haven't talked about it in a day or so. I think we had a good close, and I think that because it's options expiration, I'm just skeptical that the market continue higher this week or not. It's really a crapshoot, and the close told me the market wants to go higher, and we could, even this week, within the next day or so, we could get up another 10 points, even 20 points up on the S&P. We can get up to 2018, 2017 in the E-mini contract. We're at 2097 right now. That's certainly possible. But we can also break down again, and that's why it's very difficult during options expiration week to say, here's the direction we're going, take a stand, take a trade, go with it. You just can't do it. Intraday trades are a little bit different. During options expiration week, I'll rather trade stocks than I would trade the S&P by itself or any other index, because the institutions can certainly whip around the index, and they whip around stocks too, but they do whip around the index. And the index is it's very tricky, especially during options expiration week. So right now, I would rather just say we're in a bullish position, relatively speaking. And if we close below 2085 on the S&P E-mini, that's trouble. Okay, that's bearish. Okay, above that, we're going to stay bullish. And for now, we're going to go with that for today. Okay. And then, by the way, if we closed at 2105, okay, remember, we've had that number for quite a while. 2105, that's also very bullish and probably projects 2020, 2018, 2118, 2120, and maybe even 2130 and 35 that I've been talking about for quite a while. So those numbers are still in play. All right, let's race through the other stuff. I know I took some extra time explaining the intraday activity today. Let's go over to the gold market, and this is the gold futures. And this gold had a good day today, up $10. Not bad. We're just looking for a little more. We have to see more definitive action. There's not anything telling us yet, and I know this is another sloppy chart to most folks, but to me, it's another Rembrandt. I've got my lines in here. I've got my support and resistance lines from certain calculations I do, and other calculations that derive from Fibonacci retracement. And so when I have two that match up in a general vicinity, that gives more validity to a particular price level, and then I look to fine-tune that area, and that's when I come up with a price target or a support or resistance. So here on gold, we're still not necessarily in a bullish position because in theory, in the way I look at things, you have to get above 1207, 1207.40. So you have to close at 1208 or higher in order to get a run with any higher price of significance in the gold market, okay? So until that happens, it's fine. We had a good day, but even though there could be another $10 or $15 on the upside, in order to get the real move up, we've got to close at 1208 or higher, and that's really the bottom line. And if we continue to struggle and we don't close above this day here, this big red candle high at 1207.40, so we'll call it 1208, then the more susceptible the market's going to be to break down, in my opinion. So that's where we stand in gold. But I do project higher prices out into June and into July. But in order for those higher prices to take effect, in order for them to be realized, we really have to get over these hurdles, right? It's one step at a time. We can't go from point A to point M. We have to go from A to B to C to D. Okay, the market is it's configured in a way where in order to get to a particular destination, and destination being a price level, we have to get through a certain series of other shorter term destinations first. And that's where we're going with gold. We have to get through the short-term hurdle, which is 1208 on a closing basis, on a daily closing basis, before we can really project any higher prices. All right, let's go over to the oil market. And, here we are with crude oil, and same deal, okay? We've been talking about higher prices in crude oil. Remember, a lot of folks were calling this a top in here from last week. And I said, nah, it's not really a top until we break down below 58.63 and certainly 57, 58, and then 57. I had my support levels that I was comfortable as long as oil remained above. Then I was going to stay in a bullish stance, being long the market. Okay, so I said two price targets were $60.50, and the second price target was going to be at and around $64. So we hit the $60.50 a couple of times, and here we go again. We did it again today, and now we closed nicely, convincingly above that area, and I have to think that we're going to take a run at the highs, which is this daily high here, which is at 62.58. I wouldn't be surprised to see that tomorrow. And then I really do believe that 64 could be reached, and it could be reached in short order, kind of on this move higher, whether it's every day or not, who knows. But on this higher means before we would ever breach 58.63 again. That's my line in the sand, okay? On a daily closing basis. So all is well with crude oil. We called this market pretty good. Hopefully those that followed it made pretty good money, and you can still be long this market. You know where you're wrong, 58.63 daily closing basis. That's a little ways away. Now, if you really want to be conservative, then you would be 60.50. You would use your support and resistance lines at 60.50. So I would say daily closing basis 60.50. I would be out if I was going to be long this market in a new position. Okay. Let's go to the bond market. Let's go to TLT. This was an interesting one today. Okay. So here's one where the market looked like it was putting in really a nice reversal day on volume, made a low, started going higher, engulfing the prior day candle, and it looked like it was going to finish close to around the highs from yesterday. That was really positive, and then we crapped out at the end of the day. So if we just took a zoom in, closer look, even the 10-minute chart, you can see where we just kind of faded away for the rest of the afternoon from about 2:30 on, something like that. We just faded away, and that was a little disappointing for those that were long the TLT. I'm long TLT from down here, but when it started to put in a low, I thought we were going to get that reversal day we were looking for. We didn't get it, but let's take a look at the longer picture. So this was good support, but I said ultimately 116 would be more of a buy with three hands type of scenario, but this certainly does provide good support. And if we go over to the weekly chart, okay, you can see where this area that consolidated for a while would provide good support, right? There was certainly a lot of buyers in this area, all right? So if there's a lot of buyers in this area, they're met with the sellers here. But 116 would be a great area of support. That has additional meaning, additional significance than just a number, right? It's a calculation that I made similar to the way I showed you before. What I would say is, since we didn't get the bona fide reversal data today, it has to really show me more. I've got to see the TLT close above 121.65 on a daily basis before we can say that this is going to be some kind of a longer term low. Longer term can only be weeks. It could be a few weeks, but certainly longer term, meaning more than a day or two. But it has to show me, because the week close today told me that it's not necessarily finished going down. And if we flip over and just take a look at the 10-year yield, you can see where this wanted to put in that reversal day also. And just at the end of the day, it spiked back up. And, I think that, did we hit that high? Yeah, we did pierce through that high. Maybe it just wants to go a touch higher on the yields, a touch lower on the bonds, and then maybe we do put in that reversal day. This market, just like the S&P and any other market under the sun, it's there to trick us from time to time. And while it looked like it was putting in a low today, maybe we didn't quite make a low. We'll have to let the market show us. It has to show us the price action. It has to show me the money flow. Show me the money. Show me the money flow of where it's going. I didn't see the money flow all day today. If I saw it all day, it would be a different story. Didn't see it all day, so I'm a little weary that we didn't make a low yet. So I'm not going to call a bottom in this market, at least an interim bottom anyway. Dollar. Dollar's still a little weak today. Again, show me. We may want to come down and test this low one more time. We may want to crack that low. We'll see over the next day or two. At this point, based on some of the calculations I did, based on some of the other markets I'm looking at that trade off of the dollar, what I'm going to tell you is I'm going to probably wait to see where this week closes on the dollar. I have some numbers that are in my mind and on paper important that the dollar should close above this week. I want to see it, okay? And until I see it, I'm probably not going to be comfortable in another long position in the dollar. So we're going to go with a weekly close this week in the dollar. We'll keep talking about it every day, but on Friday, we're going to decide what the dollar is going to do over the next week or two from this point forward. So we're going to watch it. Unless something happens between now and Friday, I'll let you know. But other than that, that's my plan for the dollar. I just don't like the action, and I want to see a little bit more out of the dollar. All right, long video tonight. I'm going to give it a wrap. Hopefully it's helpful, folks. Hopefully you folks are getting something out of it. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.